Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning, young Mark.
Good morning.
Right, 4 thought-provoking slides. Without further ado, let's kick off with the first slide, oil.
Right, well, as one can see, the oil market took a bit of a bath when they mooted that they were going to increase production at today's OPEC meeting. What they actually do is very much written in the stars, but I think markets are beginning to realise, is OPEC oil output really the most meaningful thing that we've got to look at? You know, what influence does OPEC have, even OPEC plus, i.e. including Russia? And I think the other interesting part of it is actually we've had a fairly choppy, since we've started this consolidation phase at the beginning of June, the market's been very, very choppy, and that's actually true of a lot of markets.
Right.
You've seen it this week in euro dollar. You know, it's going up. At one moment, we're worried about the Italians. We're worried about the ECB being way behind the Fed. The next moment, we're thinking it's happy days. We've got the PMIs today. Services PMIs much, much better than expected. So maybe that whole thing with Draghi saying, hey, I wouldn't worry too much about the economy is correct, but we shall have to see. But with this chart, I think the interesting aspect is the oil price is obviously critical for a lot of people's long-term or short-term thinking on where inflation's going. And where inflation is going is absolutely critical for where we think central banks are going and indeed where long-term interest rates are going. So it is important from that aspect whether one elevates OPEC to be the masters of the universe or whether one relegates them to being a bit part player. So it is going to be interesting today, and I think we are in a situation in the world where we actually need now to start thinking about where are we going in the medium term. And the whole sort of trade disputes that we're having between, above all, the US and China actually plays into it, because the Chinese played an absolute masterstroke last week in their first response to, oh, I'm going to look for an additional 200 billion. Well, we're going to be looking at perhaps putting some tariffs on some of your energy exports. Oh dear. That's very important simply for the fact that actually this American boom, we can say it's been led by QE, by low interest rates, by the tax cut. But above all, if one looks at it in actual sector terms, it's been driven by the shale oil sector and
right.
all that's peripheral to it, manufacturing, construction. So the outcome of this meeting is very important. What are we going to probably get? We're probably going to get a production increase, which is smaller than the originally mooted 1.5 million. The big first question is Iran actually going to participate? Because clearly, with Iran and the US being at complete loggerheads at the moment, the very idea that the Saudis are trying to sell this on, oh, President Trump would like to see more production, so we have the oil price a bit lower, because that's very important for the midterm elections coming up later in the year. Oil price is a very, very sensitive political subject in the US. So if we've got oil prices at $75 and gasoline prices well over $3, that will be a big vote against the Republicans. So it's probably worth looking how they're going to sell this, because we're still not sure what sort of a cut. So the next chart, this is via Reuters, this is OPEC compliance in May relative to the pledged cuts. And what we can actually see from that is actually we're seeing compliance is 163%, but it's largely due to the fact that output from Venezuela and indeed Angola has collapsed, and the Saudis have been actually also keeping their production reined in. So when we get whatever increase it is, actually a lot of it is just to get oil back into line in terms of production with their current targets, rather than being actually a material increase. We had a conference earlier in the week, and someone was asked, John Kemp from Reuters, was asked about what he thought about, well, if you got regime change in Venezuela, surely there'd be a big flood of output. And the answer to that is no. It would take a long, long time to restore Venezuelan output. So there's scope there. Probably the compromise position is to increase by something like 600,000 to 800,000, and that should give the oil price a bit of a boost. So, as I said, basically, Oil price is very material for central banks, and we've got key data today from Canada in CPI and retail sales terms, and obviously yesterday we had the Bank of England meeting.
Yep.
So what one can see on that chart is obviously we had a bit of a shock yesterday. The Bank of England voted 6-3 to keep rates the same, but the very fact that Andy Haldane has now moved to the side of voting for a hike, and the language which went with the Bank of England's statement yesterday on this has rolled the pitch once again very, very heavily for August. So the markets, they're probably thinking, well, okay, the language is fine, but haven't we been here before?
Yeah.
Weren't we here at the start of the year and the Bank of England was pitching a May rate hike, and then suddenly at the end of April they got the GDP numbers and they ran scared and they deferred and they said, well, we really need to see what happens. Is this a transitional phase? My problem with the Bank of England is they're in danger of making the same mistake. It certainly looks like Q2 GDP is going to be a lot better. The retail sales numbers imply that we should have consumer spending making a solid contribution. So we get 0.4, perhaps even as good as 0.5% quarter on quarter. The Bank of England has basically said the potential rate and anything above it, the potential rate is 1.5%, and anything above it means they have to respond with a rate hike.
Right.
They've done a bit of what I'd call mansplaining on this one, because true, the consumer spending numbers were good. However, we have another look around. We had the wages numbers, very disappointing. They sort of tried to pitch this forward, for which there's no really good concrete evidence that they're expecting wages to pick up again. Well, they did this before. Then they had a great bit of trying to rationalise that really, really weak industrial production and construction output numbers. Now, they may not be the biggest part of the UK economy, only around about 20%, but they are important because they are a bit of a proxy for what's going on. And they basically said, well, it looks like we had a bit of an involuntary accumulation of inventories in Q1, but that will go away. Well, we'll see about that, particularly when one considers we're in an environment where global trade and the manufacturing sector is coming under a lot of pressure because of the steel tariffs on Trump that Trump's imposed on steel and aluminium. So I wouldn't want to be so sure that the manufacturing part, but at the end of the day, I suppose the UK is a services economy. We seem to have a little bit of calm on the Brexit front.
Yep.
So let's compare and contrast that with Mr. Carney's previous employers.
The Bank of Canada.
The Bank of Canada. We've got inflation numbers coming out today. Interestingly enough, headline inflation up 0.4. Going to take, if the forecast is correct, it's going to take the year-on-year rate all the way up to 2.6%. That's the highest level we've seen in Canadian CPI since February 2012. Okay. So, this is quite a major move. That said, their core measures of inflation are expected to be around the target. So there's still a reasonably well discounted chance that one can see 65% roughly of a rate hike at the next meeting in July. But the good thing here is, unlike the Bank of England, the Bank of Canada is just basically saying, well, we need to see what happens with the whole NAFTA negotiations, which are a little bit on ice at the moment. And we'll do whatever is necessary, and we are sensitive to incoming data. Now, when they say they're sensitive to incoming data, they don't then go and explain anything. They
don't comment on it, do they?
They don't explain it away. They just take it as it is. Yep. And this is the big difference between the Bank of England and the Bank of Canada. And obviously, Canada would benefit if we did start to see, on the back of the OPEC meeting, a bit of a rally in oil. That would, I think, assuage some of the doubts. I think there's a few there's a whole load of interesting things around. I just thought I'd shed a bit of light in a couple of different corners this week.
On that note, Mark, thank you very much indeed.